But just to start with, Prashant, very standard questions, which I know I've heard you talk about this in multiple forums. Why does White Oak PMS have such a diversified portfolio? Doesn't it actually, hinder returns rather than create returns when we have 50 stocks out there? And second, how do you time, right? Should you come in a staggered approach, or should you actually be putting lump sum investments out there?
Certainly. Before I answer, Prateek, I have a question as well from a client to you. How do they, if they want to, how do they go to the Vivek and Nitin session?
Okay, so you'll have to come back. So we are in the auditorium room right now. You'll just have to come back, and there is a parallel, there's a work stream which is there, which talks about a breakaway group on the product side. So you'll find that. You'll just need to click that when you come into the main introduction part, which is there. So as somebody would have logged in, you would have come to the auditorium, and there is also another tab which talks about a breakaway group. So Prashant, the respective gentleman would have to just click that, and both Vivek and Nitin would be there to run through the presentation on products.
Certainly. So now I know we are running over time, so we'll try and make it more of a rapid fire Q&A for this session. The question that just asked, the first one about the number of names that the team owns, that generally takes a lot longer. So I'll try and make it brief by using an example. See, one should not forget what is the end goal. For our team, it is clear that the end goal is to maximize returns for the portfolio, for the clients, right? We don't want to be handcuffed or shackled by any, oftentimes I believe this concentrated portfolio, focus portfolio, 20 name portfolio, these are more marketing gimmicks. They are made out to be good for generating higher returns, whereas we believe there's no fundamental underpinning to that. In fact, we can provide as a lot of evidence that is counter to that. It has been our firm view, and not only here over the last 4 years, but over my entire career over decades, it's been my firm view that in a country like India, where liquidity is so low, having the flexibility to own larger number of names allows a team to generate higher returns. The diversification benefit, and that's why I use the word having the flexibility to own larger number of names, rather than saying having the flexibility to diversify the portfolio, even though they mean one and the same, but there's a subtle nuance here. The diversification benefit of reduced risk is just a byproduct. The main aim is to increase return. And quickly, as an example, let's assume a good manager managing 20,000 crores of AUM. There are several good managers managing 20,000 crores of AUM. And they, let's say, to keep math simple, have a 20 name portfolio. What they say, it's a focused portfolio, won't go over 20 name, 15 name, 20 name, let's use 20. That means on average, they'll be investing 1,000 crores per name. Let's say, stay with round figures. To invest 1,000 in a company, the market cap of the company typically would need to be at least 10,000 crores or more, and more often would need to be, at least 15,000 crores or more, taking into account how much the promoter owns and whatnot. Now, the number of companies that are 15,000 crores or more in market cap is fairly limited in India. Over the last 12 months, it's increased with the way the markets behave, but it's still about 200 names. And guess what? Everyone of the fund managers who has this so-called focused concentrated portfolio is focused on these same 200 names. They miss out on hundreds of other names. Like our investment team considers our investable universe well over 500 names. So they miss out on a lot of mid and small cap names, which are otherwise gem of opportunities. But a 10,000 crore name or a 5,000 crore name, they miss out because you can't invest 1,000 crores in a 5,000 crore company, right? Whereas we, having not shackled ourselves or handcuffed ourselves with a 20 name portfolio, we have the ability to put in a name at even 1% of the portfolio. If you can't buy 5% or 4%, but you can buy 1%, then why leave 1% opportunity? So some of the names that were talked about today, like Naveen Fluorine, when the team bought it, initially the stock was 3,500 crores or so in market cap. Intellect Design that Ramesh talked about earlier, again, a 1% position when we bought was about 3,500 crore market cap position. These two names, and there are at least 6 names in our top 10 contributors over the last 4 years, which if we had an artificial constraint like a 20 name, 25 name portfolio, we would not have been able to buy. Despite 1.5% position, these companies have done so well. They've gone tripled, quadrupled, sixfold, sevenfold increase. Dixon is up 6 to 7, sevenfold, I believe, over the last 2 years. We bought it again when it was 3,500 crore market cap. Now, when it's 25,000 crore market cap, this is a time when others, who might have 10, 15, 20 name constraints, they might have start looking at them. But our team is able to maximize performance by investing in gem of opportunities in small caps, and we believe it's only counterproductive. See, the game of investing to begin with is competitive enough, in its free form. If you are to handcuff yourselves on top of it with such artificial constraints, you are going to generate suboptimal returns. And hence
Sure, Prashant. I think I guess you make a point. And when people talk about the investment team at White Oak, there are a lot of success stories people have talked about in the mid-cap IT space, in specialty chemicals, and and even now in the financial services sector. And a lot of it is attributed to the philosophy of having a diversified space. So while there may be a good marketing ploy around running concentrated portfolios, but does it finally deliver returns is really a more question, is this thing. Prashant, on the other point, whether one should be entering the market at this point.
It all depends. I would say it's like staggering over time basically gives you time diversification. It doesn't come free because the amount of time. So if you have, let's say, 1 crore rupees, and if you were to split it into 10 parts, 10 lakhs, 10 lakhs, 10 lakhs over the next 10 months, only 10 lakhs is immediately deployed and earning a return. The remaining is sitting in fixed deposit or something, losing in real terms, right? So the last leg of 10 lakhs, which will come in 10 months time, would have actually sat in fixed deposit for 10 months. So that's a cost you are paying. It does not come, the diversification does not come free, time diversification. You can think of it as insurance you're buying by time diversifying. And then it's really up to the person how much insurance they want to buy. Insurance is a negative NPV undertaking, but we still do it if the risk is substantial. If someone has a 100 crore portfolio and is worried about how to, and let's say they sell a company and they get 100 crores and when to invest and how to invest the entire 100 crores, maybe it makes sense to buy some insurance and spread it out over time. If someone has 100 crores and is wondering about how to deploy this 1 crore out of their 100 crore net worth, then you have to think, do you really need to buy insurance for this small an amount? Right? It's like I often say that does Bill Gates need to buy health insurance, for example? It does not make sense, right? So if the amount is small enough, you don't need to, incur the cost of buying time insurance.
Sure. And I think one of the things, Prashant, which I've always heard you say is what proportion of the portfolio is really somebody investing, right? If it's significant enough, then of course, people may look in terms of staggering. But if it's going to be 5% of your overall net worth or 10% of your net worth, then the cost of insurance tends to be a lot more. And you might as well as allocate to the market. Manoj, sorry, there's been a lot of questions around specialty chemicals. And one of the most important points, which may not be applicable only to specialty chemicals, is, are the companies, which you've discovered, are they in a bubble zone right now? Is next 4 or 5 years earnings already priced into the price which you're seeing today?
Yeah, thanks, Prateek, for that question. So obviously, no doubt that the chemical sector in general has done very well over the last few years, and which is largely on account of strong cash flow growth and improving long-term growth visibility. However, if you look at at White Oak, the key philosophy of our investment thesis, what Prashant has also spoken about, is 2 key attributes: great businesses and attractive valuations. And hence, to that extent, we are very, very focused in terms of not only finding the great businesses, but even seeing whether those businesses are offering significant upside to the current fair value. So if you look at it, while a lot of people talks about in terms of valuations with the P multiple or traditional EV/EBITDA multiples, however, to us, those are distorted, misleading, and can lead us to the wrong conclusion. For us, the value of the business is the present value of the future cash flow. And hence, we don't look at maybe, just the next 1 year or 2 years kind of profitability.
And just to add to what Manoj is saying, Manoj and Sagar and the team have exited several chemical companies that they had invested in once they reached not even reached, because of the competition for capital on the team, including in the chemical space. The team doesn't even wait for a company to reach fair value. Most often exits while there's still some money left, because that money can be reallocated to other opportunities which are higher upside.
Sure. No, and Prashant, I'm assuming that the same argument would be valid for the rest of the sectors which are there, because we've looked at exiting some of our best performing stocks at the peak. So you're not really married to a position if the value doesn't look right? I mean, that's one of our core philosophies which we have.
Yes, absolutely. That's core pillar to the team's thinking and approach. See, there is, again, these are oftentimes marketing gimmicks, so they sound very good to the layman. Buy and hold. And what is so good or what is so extraordinary about buy and hold if it does not maximize your return? If a company's valuation has already reached, think of it, when you're buying a company, what are you buying? You're buying a piece of the business, small piece of business. If the valuation is reached such a level that, and think of your portfolio as the capital you have. So everyone likes high return on capital, right? If you've invested a portion of that capital into a company, you are entitled to certain cash flows from that company. If the price becomes so high that at that price, the return of the capital on that from the cash flows of the company falls a certain level, below a certain level, and there are more compelling alternatives available within the portfolio. Because remember, our portfolio is full of great businesses, right? So if a particular company the valuation gets stretched, it's better to redeploy that capital into another company where the cash flow streams would justify a much higher return on the client's capital. So yes, we are not wedded to any particular such.
Sure. Sagar, I'll just, there are quite a few questions which have come around the whole ESG frame, the ESG framework, and how is this going to impact the specialty chemical? Is it positive? Is it an enabler, or is it going to, cause a lot more costs into this? What would be your, view around how ESG is going to, make think how is it going to impact the whole, specialty chemical space?
Yeah, thanks, Prateek. And the reason why China is in the current position that it is right now is because of not being ESG compliant, right? I mean, they were very reckless about their manufacturing practices and did not invest in effluent treatment plants to follow a sustainable way of growing their business. And for at least from our perspective, these investments into ESGs or EHS, they're a necessity. They're not optional. Okay, so if you come across a company that thinks that this is optional, then I would suggest that you stay away from it. So hence, to build a sustainable business, we genuinely believe that these investments will have to be made. Sure, they could impact your margin in the near term. They could have some little impact on a balance sheet. But to build a large sustainable business where you have, confidence of the customer and you are able to provide great quality, I think these sort of investments would definitely help companies in scaling up for the long term.
Sure. Great. Thanks, Sagar. Of course, on this whole, Ayush, you gave a very nice framework, right? Today, there may be a lot of headline news around 1 lakh crores and, how valuations are getting created. So there's an interesting question which is coming out here. You did point to the 5 points out there in terms of how we are valuing these businesses. But would White Oak really need to revisit its valuation framework or approach when we start looking at the emerging consumer tech companies?
Yeah, thanks, Mary. So like we said, the valuation framework remains exactly the same. We are still looking for high returns on capital, scalable opportunities, strong execution and governance, and we want to buy them at a discounted intrinsic value. Just that the tools to analyze each of these attributes, they need to slightly evolve, right? The things that we talked about around customer acquisition cost, to retain around the quality of networks. So the quality assessment that goes into analyzing each of these attributes and the frameworks to analyze of the attributes, that changes slightly, but the broad framework remains exactly the same. And that's what I think we talked about in the latter part of the presentation.
So if I may just add here, this is a question that Ayush and I often get in client meetings, whether the OpCo-FinCo framework would need to be modified to value such companies. In fact, there is no...
Prashant, just maybe you can also, so there's another question around, do we need to, just if you were looking even at technology companies today, right? How would you really use this? Since you were talking about OpCo-FinCo, I just jumped into this particular part. Maybe you can take both of them together. How would you value the technology companies also today in this whole OpCo-FinCo framework?
Technology meaning the IT services?
IT services company.
Okay. So we can talk about technology companies, consumer companies, any companies. In fact, this new age tech companies, if you will. This is the, I would say, most appropriate and the only way to, while we might say this is the most appropriate, only way to value all the other companies, but how would you even apply a flawed, even if let's say we all agree that PE multiples are flawed, you can't even begin to apply that flawed model on valuing some of these new age companies, right? And those who are limited in their valuation approach to the flawed PE multiple approach, hence throw up their hands. Either they take the leap of faith blindly because everyone's buying, they'll be buying as well, or they throw up their hands and say, boss, this is overvalued, this is crazy, this is overstretched, this, that, and the other. The only way to value is the way to value any other business also. The most fundamental way to value any business is that value of a business is present value of future cash flows, right? So the DCF value, remember our OpCo-FinCo framework is an enhancement to the DCF value, where we break the DCF into two components, the FinCo and the OpCo. Now, certain companies may have no FinCo, and that's perfectly okay. It is broken into two components where the FinCo component may be 0 or 1% or 2%, like Unilever has no FinCo. Nestle has no material FinCo. 1% of the value of Nestle is in FinCo. IT services, we talk about, they have very little in terms of, hardware and some capitalized software and maybe buildings where their employees are housed. But there too, a low single digit % is in FinCo, lot more is in OpCo. So the framework is very fundamental, very basic. It applies to every sector, including IT services, the traditional IT services, including the new age businesses, right? It is the P multiple model, which anyways gives apples to oranges comparison when applied to traditional businesses, and is not usable at all when evaluating new age businesses.
Sure. Yeah, that's Ramesh, just coming to this point which Prashant has just made around this whole PE model, traditionally, and you spoke about this in your interviews at Bloomberg when people did speak to you about valuing consumer tech businesses. You're also seeing many other now new age businesses, there's which has been filed on the financial services space and things like that. Do we so one of the questions around here is that have markets really now gone way ahead of its fundamentals, and are these so-called non-profit making businesses going to cause the market to turn around from a cycle perspective?
Sure. So first, as the team had talked about, right? The profits are not a way to value. Just because currently a business does not have profits does not mean it will not have future cash flows. So what really matters is the present value of future cash flows, not the current cash flow. The current cash flow number can be a negative number. Number two, as Rohit and Ayush had talked about in the presentation, we are at still a very early stage of evolution of the consumer internet in India. Our penetration for e-commerce is 5% versus China in the 30s. So that is the potential. So that is first the main factor to think about is the long-term growth potential. Number two, technology is a very heterogeneous sector. As Rohit and Ayush had talked, there is a variety of business models. What will really matter whether value will get created or not
whether companies have positive unit economics, they will serve large and growing markets, and can execute extremely well. So technology will create large winners and losers. There is no single answer that an X company will do well. And if people are not invested in loss-making companies, then they would have never invested in Amazon, right? Which is one of the most defining companies in this century. So it is all subject to the individual company dynamics that will work. There's no single broad brush answer that can be given.
Okay. Thanks a lot, Ramesh. I guess we've far exceeded our time right now. There are still questions which are coming in, and hopefully we will take some of these questions over the next quarterly connects, which we would do. Thanks for the investment team, and thanks all our clients and all our partners who were here on this call. And we look forward to continuing this interaction with you over the next few days, few weeks, few months. And thank you for supporting us in this.
Thank you. Thank you all for taking the time. Thanks for joining us this evening.
Thank you, everyone.